Target is in far more trouble than people realize. New evidence shows that the popular retailer is now dying before our eyes as the perfect storm of events strikes America's biggest chains. Facing a $400 million shortage in cash flow, declining sales, plummeting profits, and crashing shares in the stock market, the company is hanging by a thread. To make things worse, supply chain imbalances and bloated inventories are still forcing Target to mark down prices of several items due to lower demand, which is further depressing its bottom line. At this point, the store chain looks like the next perfect victim to the unforgiving retail apocalypse. And in today's video, we've compiled several worrying numbers that reveal just how ugly conditions are for this beloved retailer. But before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe to our channel. 2023 is not allowing retailers to catch a breath now that companies have reported their earnings results from the past quarter, and economists and investors alike are analyzing the numbers to know what to expect for the months ahead. It's getting evident that the outlook for retail this year is much worse than everyone expected. And the greatest proof of that is the fact that even some of the biggest retailers in America are facing severe hardships and huge financial losses. Right now, Target is undoubtedly the one coping with the hardest challenges after an extremely turbulent 2022. In fact, the company has demonstrated just how quickly things can change in the world of retail. During the pandemic, it reported an excellent performance as sales ballooned. But over the past year and a half, conditions have drastically changed due to a perfect storm of events that have hit both its supply chains and balance sheets. As a result, the retailer now expects negative results for the first quarter of 2023. In its latest press conference, Target described the current environment as very challenging, as its shoppers aren't being attracted by the discounted products the company needs to sell before bringing forth new merchandise. We're competing in a constrained environment for consumer spending, said CFO Michael Fidelki. By the end of April, Target forecasts that in its coming earnings report, sales will face a single-digit decline compared to a year ago levels. It also sees an operating income margin rate of 4% compared to a 6% rate that lingered for almost 15 years. The most worrying numbers released by the brick-and-mortar retailer showed a 43% drop in profits and lower than expected sales for the holiday quarter, reflecting its ongoing problems of cautious consumer spending and higher operational costs. That marked Target's fourth straight quarterly profit drop. In 2022, it faced a 40% decline in profits in the first quarter, while earnings plummeted nearly 90% in the second quarter and 52% in the third fiscal quarter. It's estimated that the company has lost about $1.2 billion over the past 12 months alone, and part of the blame can be attributed to its chaotic supply chains. In June 2022, it was the first time the discount store chain signaled that something was deeply wrong with its inventory. It began canceling orders from suppliers and aggressively cutting prices to be able to get rid of goods that consumers were no longer interested in, which deeply hurt its bottom line. Consequently, its gains fell from $1.54 billion, or $3.21 per share, to just $876 million, or $1.79 per share compared to the prior year. And if all this stress wasn't enough, market scale data exposed that the department store chain is also dealing with a $400 million shortage in cash flow. As it turns out, Target's merchandise is disappearing from store shelves, but not in the way that the company would want it to. Inventory shrinkage, or retail theft, has sharply reduced the retailer's gross profit margin, compromising its flow of cash. According to Retail Dive, the company actually reports 4 times more cases of looting in its stores than other major competitors like Walmart and Kroger. Now that it's operating in an extremely tight environment with no room for error, investors are clearly seeing how vulnerable the retail giant really is, and how ugly is the outlook for 2023. Last month, a spokesperson revealed that Target would introduce radical cost-cutting measures with the goal of saving $2 to $3 billion over the next 3 years in an attempt to restore its financial balance. Those steps could include widespread layoffs or hiring freezes in the coming months, executives said. In an interview with CNBC, Fidelki pointed to a deteriorating outlook for consumer spending. In February, consumer confidence plunged for the second consecutive month, with consumer expectations for the next 6 months reaching their lowest point since July 2020, and that's according to a recent report by the Conference Board. That is because skyrocketing prices have put extra pressure on discretionary spending as consumers make room for higher prices on necessities, the CFO highlighted, adding that rising interest rates are already having a devastating impact on mortgage and car payments. The company also mentioned shifting consumer behavior as a factor to watch both in 2023 and beyond. While some consumer behaviors have returned to pre-pandemic norms, others, such as the popularity of hybrid work and more engagement with digital sales, appear to have changed forever, Fidelki continued. On top of that, other factors are still affecting its resilience in the industry. The popular store chain is still facing elevated costs in its global supply chain compared to pre-pandemic periods, for example, while also coping with a slide in its credit rating as the Fed's tightening policies send shockwaves through the retail sector, Fidelki noted. For that reason, Target forecasts annual earnings of just $7.75 per share, below investors' estimates of $9.23, Refinitiv data shows. We're planning cautiously given the economic challenges we anticipate this year, said Target Chief Executive Brian Cornell. The financial sector is reacting accordingly. On Wednesday, Wells Fargo published a very gloomy analysis discussing the future of the retailer amid a murky consumer backdrop, which led the bank to downgrade Target stock last week. Analyst Edward Kelly lowered his rating for Target shares to equal weight and cut his price target to $142 from $170. Target's outlook has deteriorated meaningfully, and we no longer see it as an attractive investment into an uncertain 2023, the analyst wrote in a research note. Kelly's concerns include weak foot traffic trends at the retailer's stores that have been persisting for months, as well as a very slow margin recovery, uncertainty over the company's ability to scale its model, and the potential for a sustained period of comps weakness. Another source of uneasiness for Kelly is Target's reliance on general merchandise sales rather than groceries. The current economic downturn means that shoppers will spend less on general merchandise such as home appliances, apparel, and beauty products, which would have an outsized impact on Target's sales, he writes. The analyst warns that Target's general merchandise sales could decline by double digits in percentage terms in the final quarter of 2023, which would represent a more accelerated decline from previous years. Put together, these factors imply there is limited upside for the stock, Kelly stressed. The difficulties faced by the company continue to pile up. In recent weeks, shoppers have taken to social media to complain about empty shelves at the produce aisle, short supply of dairy products, eggs, and many cold and flu medicines at Target stores, indicating that shortages may be making a comeback for the retail titan. On the other hand, loyal customers may only have a few weeks left before Target closes several stores across the country. Given the myriad of issues it's facing right now, the company is being seen by industry experts as the next perfect victim of the retail apocalypse. With dozens of underperforming locations at a time, it is struggling financially, and it has become unsustainable to maintain some stores open. By the end of May, several locations in Minnesota, Pennsylvania, Washington, and Ohio will be shuttered permanently, according to a report by the U.S. Sun. The decision to close these stores was extremely difficult, a Target spokesperson told the news outlet. It's an action we take only after multiple years of working to improve performance. After the announcement, Citi retail analyst Paul Leger wrote in a note to clients that the situation the company is in right now should send shivers down the backs of its retail competitors in home and apparel. While clearly a negative for Target, this is a bad development for the retail industry generally, particularly those that play in categories where Target is most over-inventoried, which are seemingly home and apparel, he explained. Its recent announcements show it's still struggling to adjust to recent trends. At the end of the day, the entire industry is in survival mode. A tidal wave of bankruptcies is coming. The retail industry is facing a potential tidal wave of bankruptcies later this year as rising prices hurt consumer demand and the supply and demand crisis takes a turn for the worse. The biggest risk companies have in 2023 is that market trends change much more rapidly than they used to, and being slow to react can be detrimental, said Isabella Sun, CEO of Short Story. Unfortunately, that has been the case with Target up until now. On a similar note, Bob Rogers, CEO of Oi.ai, a data science company specializing in supply chain modeling, highlighted that we're still far from solving issues related to global supply chains, and that's a problem that will continue to plague businesses throughout the rest of the year. What people don't realize is that most supply chains are configured manually. That means there's a human adjusting the parameters every time an interruption occurs. But that's a tedious task that people are simply too inefficient to do successfully on a large scale, he commented. As has always been the case, retailers that are grappling with the heaviest debt loads and the biggest financial losses are going to be the most vulnerable to bankruptcy, added David Berliner, chief of BDO's business restructuring and turnaround practice. Consumers are getting more stingy with their wallets, Berliner said. There are going to be winners and losers, like we always see. We're just not sure yet how soon it's going to happen. Berliner said he has been keeping a close watch on consumer debt levels, which are hovering near all-time highs. Consumers that have been willing to spend over the past year are now on buy now, pay later programs, he said. I'm afraid a lot of consumers are going to be tapping out their credit cards, and then they're going to be forced into an abrupt pullback. When some of the country's most famous retail chains file for business bankruptcy, it puts the entire economy at risk. Almost 10 million Americans work in retail, and another 40 million jobs rely on it. Brick-and-mortar stores currently account for 87% of retail sales here in the United States, but that figure is expected to drop to 72% by the end of 2024. Retail is an industry in transition, and if stores and chains are not able to adapt to new market conditions, they will face a grim future. Sadly, Target isn't standing on solid ground as most people would assume. The decay of this popular retail chain looks like a slow-motion train wreck that is happening in plain sight. What lies ahead is still anyone's guess, but considering all of the red flags, it feels like the worst is yet to come. Thank you very much for watching.